Good morning, ladies and gentlemen, and welcome to the show. Really glad to have you guys here. Today is November 27th, 2019. It's a Wednesday, and let's get started. Let's open up the charts right here. The repo operation that's ongoing, they consider this to be modest-sized. The Fed. Billions of liquidity they're dumping into the system, and officials also considered modestly sized. Now, they can actually extend this to much bigger repo operations. This repo operation is helping to move energy into the market so that they don't have to cut interest rates further. They don't want to cut interest rates further. This is what this is all about. The minutes also said that effectively offering as-needed liquidity, such a facility could increase the risk that some institutions may take on undesirably higher amounts of liquidity risk. Officials also considered modestly sized, relatively frequent repo operations designed to provide a high degree of readiness should the need for larger operations arise. So, they're prepared. In the repo market, they're prepared to go much bigger than they are right now. But they're trying to preserve these interest rates where they are. It's a little bit of firepower they have left between where they are right now and 0% interest rate policy. They're trying to preserve that. The Fed is at all costs. Let's get into the market right now. Let's take a look at what's going on with the prices of everything. We're looking at silver's down a little bit today at $16.89. But I'm going to tell you, it's on a little bit on the low side of its range that it's had for the last little while. You see this green line? It hasn't broken through that low side of its range yet. So it could bounce up this afternoon, stay in this particular range that it's in. Let's take a look at gold. Gold's the same thing. It's in that range at $14.54. Now, I'll tell you, I'm not expecting any real breakouts to the upside on gold and silver right now because of what's happening in the markets. It's risk-on environment right now. They're all out there. They're not paying much attention to gold and silver right now. They're out there buying into the stock market. That's because this flood of liquidity is coming in from the repo and from these market operations where that's actually quantitative easing. Let's just call it what it is, quantitative easing going on. And you know, quantitative easing stimulates the market. That's a no-brainer. We saw what quantitative easing 1, 2, and 3 did in Operation Twist back in the day, you know, and that's how the markets got up to these heady levels. Let's move on. Cryptocurrency today. We're looking at a market cap of $197 billion, $197.8 billion. Now, it was down lower. It's come up a little bit. It's come up $1 billion or two, you know. But I don't really expect cryptocurrency to go anywhere through year end as well. You know, the markets is where it's at right now. They're being pushed up. And I want to talk about that in a minute. Let's take a look at this. Powell aces tricky Fed transition and ending interest rate cuts. So, this is what it's really all about right here. They don't want to cut interest rates any further. They're going to work with what they got going on with the repo market, injecting liquidity in, and they're also going to work with what they got on the pushing this new quantitative easing. They might increase these programs even if they have to. They're ready. That's what they said in that other article. They're ready. They're ready to expand the size of these programs if they have to. They don't really want to cut interest rates anymore. They want to hold that little bit of firepower that they have. Let's take a look at the Dow today in this melt-up. Now, I want to point something out to you guys. And this is a very important point about this melt-up in the market, this moving up. Picture in your mind a rubber band. When you first start pulling a rubber band, it doesn't take much to pull it. It pulls real easy, you know. But as you stretch it out further and further, every half inch you stretch it requires that much further effort. It's an expanding sort of a thing. It's almost like I don't exactly know what the technical term for it is. When you're like pulling on a rubber band and every half inch you pull it, it requires twice as much effort as the last half inch. I'll tell you what it's similar to. It's similar to water pipes. If you guys worked with water pipes before, if you double the size of a water pipe, you're not doubling the volume or the flow through the water pipe. You're going like 10 times each time you double the size. It goes like 10 times more water can flow through the pipe rather than the size before, you know? That's the way the market works going up. Every time you go up 100 points now in this over-leveraged market, it requires so much more because it's already over-leveraged. You're like adding to it. And so that becomes pressure on the market, downward pressure. It's like the rubber band wanting to go back to its original shape again. See? And so now we've reached that point where the market is so overvalued that to dump in the excess liquidity into the repo market or into the quantitative easing that they got going on does push the market up, but it requires so much more to push it up every little bit because it's already so overvalued, if you see what I mean. And the higher they push it, the more likely it's going to fall, but they don't have any other direction that they can move with this. They have to keep pushing the market up because they've created so much pressure on the market to go down. Anyway, that being said, with the amount of liquidity that they're driving into the system, I expect this melt up to continue. Probably right on through into past Christmas, right on in through the new year. How far could it melt up? It's not unquestionable that it could go past 30,000. You know, I mean, if they keep pumping liquidity in. I mean, this market's going to keep going up as long as they keep pouring in excess liquidity, you know. But there comes a point where it becomes like pushing on a string. In other words, the tension in this market becomes so great because it's so overvalued in the end that they have to just, I mean, it gets to the point of being ridiculous. Let's take a look now at crude oil. It's down 15 cents on the day for crude oil. U.S. Treasuries. Want to point out something about this too. It seems like one day, honest to goodness, it's like a 24-hour cycle here. One day the yields drop, the next day they go up, you know? And today they're going up about 3 basis points. Yesterday they're like dropping 3 basis points, like up, down, up, down, up, down. It's like watching marching, you know? Up, ho, you know? And anyway, here's the thing. What's causing that action? Could it be one day the Fed's buying treasuries and the next day foreign countries are selling them? I don't know. I'm just guessing at it. But, you know, I think that the biggest buyers of treasuries, is the world's central banks. And they have to keep buying them. They just can't stop. You know, because the economy would crash if they stopped. And so this is a process that's going to continue. So basically what's happened is they are monetizing the entire system. That's basically what it boils down to now at this point. They're monetizing the entire system. Take a look at at the U.S. dollar index. 98.41 today on the U.S. dollar index. You know, it's kind of a sad time we live in now, where the world's central banks are quite literally doing direct monetization of the entire financial system. It's a dead financial system. And the whole financial system now has become like a zombie financial system. It's just running now off of full steam. We're into full steam ahead with modern monetary theory. I see some point in the future, not too distant future either, where modern monetary theory will have failed, and the governments on Earth are going to make it illegal to even try that again, because it's such a failed experiment in the end, you know? And we'll have some sort of new monetary system where markets actually work again. And it'll be like a real taboo for the financial system to do this sort of thing. I can see a world coming, because this is going to fail so spectacularly, you know? And it's all going to be down to modern monetary theory, which is the craziest thing on earth. You just create money, and it's like the same thing I've tried to explain a lot of times, how a farmer might think he can fly by his bootstraps. It sounds logical, you know? Like trying to pick yourself up by your own boots. It sounds logical, but it doesn't work in reality, and that's the way with modern monetary theory. It sounds like if you have explained to you, it sounds like it's fairly plausible. It could work, but there's something wrong with it. You just can't enrich yourself by printing money. They're going to get it in the end. They're going to really understand that it won't work. Anyway, listen, thank you guys for listening. Like and subscribe. Give me a thumbs up. We'll catch you guys in the next video. Bye-bye.